Reserve minutes released earlier this week show officials worrying about a global slowdown. You think? Financial market sell-off that could hurt the U.S. economy. With market volatility throwing a wrench in the Fed's expectation of smooth sailing, I spoke with PIMCO founder and Janus Capital portfolio manager Bill Gross and asked him about policymakers and do they have reason for this uncertainty, and what about negative interest rates at 5 central banks around the world?
I think there is. It centers around global economic conditions as opposed to domestic. I think the Fed is, well versed and very happy in terms of consumption and a 2% GDP number for the U.S. But I think they observe problems in China, they observe problems in emerging markets, and they think eventually that those problems might come back to the United States. And so they're cautious. They probably won't move in March, and they may not move for the rest of the year, depending upon those conditions.
Yeah, really interesting. I want to talk more about that and what's going on globally as well as the United States. But let me kick it off with what we're seeing right now, and that is negative interest rates around the world. Bill, at this point, 5 central banks have now gone to negative interest rates. Most recently, of course, Sweden, on the heels of the Bank of Japan taking rates into negative territory. You've been talking a lot about this recently.
I have, and I think, the Fed and other central banks for 20, 30, 40, actually for 100 years have followed a model of lowering interest rates to improve a near recessionary economy or a slow growth economy, and raising interest rates to cool off inflation. That's been their basic model. I think ultimately, though, that interest rates at the zero bound, negative interest rates in some countries, as you mentioned, has some negative impacts that aren't reflected in their historical models. For instance, if interest rates are zero or negative, then the returns to banks are lowered in terms of their net interest margins. We see that in the price of bank stocks. Also in terms of insurance companies and pension funds, and ultimately, Maria, savers. If savers can't earn interest on their money, then what happens to that money, and what happens to credit and capitalism as we know it and as we have known it for the past 100 years?
Do you think the U.S. economy enters recession this year?
I think perhaps next year. There's a good indicator, Maria. The Atlanta Fed runs a model. They're suggesting that this quarter, this is the first quarter, not the first year, but they're suggesting that this quarter GDP in the 2.5% real growth range. I think ultimately the critical thing, Maria, is the nominal GDP. That is real growth plus inflation. And I think ultimately a Fed in the United States has to produce nominal GDP of 3 to 4%. It's only been 2.8 or 2.9% over the past 12 months. And why do we need 4%? We need it to service debt, and we need it to service expectations in the equity market, because you need 4% nominal GDP to grow profits, and that hasn't been taking place. So I don't see a recession, but I think critically we should be looking for nominal GDP at 2%, which to me would be a nominal GDP recession.
Wow. So it could actually be not necessarily officially a recession, but it might feel like a recession, which I think a number of people will say they're feeling right now, given that they haven't seen wages move. What does a recommended portfolio look like today from your standpoint?
Well, I think it should be de-risked. That is very conservative, because this is a marketplace. This is a financial economy that's highly levered, Maria. And when you have still a high amount of leverage, and we heard Neil Kashkari from the Minnesota Fed talk about that in recent days in terms of banks and too big to fail, it reflects simply an economy, and a global economy in which we still have a high level of debt that is very sensitive to interest rates. And so, I'd say de-risk. I don't like high yield at the moment because it's too volatile. I don't especially think that stocks are going to go up, 10% over the next 12 months. And so, stick to those safe arbitrage, those closed-end funds that yield 6 to 7 to 8%. Those are in my own personal portfolio, and it's been looking pretty good for the past 12 months.
In terms of broad portfolios, that includes equities, Bill. Are you expecting a real volatile year? What does 2016 look like when you look at the equities market?
Yeah, it has to be volatile, and that's the word that all analysts use. It doesn't mean much. That simply means that prices go up and down and a lot, I suppose. You know, as reflected by the VIX index, which is a measure of equity volatility, now around 22 or 22%. I think that basically is where we will be for the rest of the year. That's about twice as much volatility as what we've had in prior years. So does that mean 1 to 1.5% moves on a daily basis? Almost.
Wow.
Because the market is uncertain in terms of the economy, uncertain in terms of the negative interest rates, and uncertain as to whether those negative interest rates will do any good.
And my thanks to Bill Gross there, coming to us from California.